direction of prices through the study of past market data, primarily price and volume. Over time, it's definitely been an increasingly popular because of its easy and visual nature of the indicators, meaning you can see the indicators on the screen. There's nothing abstract about it. There's nothing kind of out there. You can visually see if something is a buy or a sell. But this also falsely leads to the assumption that the markets are predictable. And I personally think this is one of the biggest points that I want to make in this video, is that the visual nature and the easy to read nature of technical analysis does not mean that it is predictable in determining the outcome of the direction of a stock. And I know that a lot of people fall into this pitfall early on in their trading career, is that they see the technical analysis indicators and it makes sense to them on a logical basis. So then they assume that because it makes sense and because they can see it, that it therefore is predictable, or you can basically make assumptions off of it or trade even profitably off of some of these indicators. And I'm here to tell you that that's just not the case. So there's a couple different types of technical analysis indicators out there, or methodologies. There's first, like your general support and resistance. So the stock goes up, it hits an area of resistance, comes back down, hits an area of support, etc., etc., etc. Then you've also got candlestick patterns. These are patterns relating to the open and close of the price movement in the day relative to the high and low. And again, it's not the actual candlesticks themselves, but it's the patterns that evolve through these candlesticks. So, a 3-day or 4-day pattern might tell you something about, what the stock might do in the future. And then we have chart patterns, which are really, really popular. Things like head and shoulders patterns, pennants, flags, all these different things, cup and handles. I mean, you probably heard them if you've been involved in trading, but all of these different patterns that are out there that you can basically, build and write and draw on with all of your charts. Now, in my honest opinion, a lot of these are subjective in nature. What might look like a head and shoulders top to you might also look like an uptrending pennant to another person. And you can't argue with that. With regard to candlesticks, chart patterns, support and resistance, it is all subjective, meaning it's what you see out of the charts, not necessarily what may or may not be there. Now, since I'm generally more of a math and numbers trader based on probabilities and statistics, I prefer to use indicators that give clear buy and sell signals on the charts. And that's just how I'm wired. So obviously, I want to go through some of these examples here so we can kind of start to lay the foundation in this video for how we can kind of use signals that are less subjective than, say, chart patterns or candlesticks, things like that. So first thing that we're going to do is we're going to look at a chart of SPY. Now, this is the SPY at the time that we're doing this video. This is actually the last 2 years on a daily basis. And what I've done here is I've overlaid just a simple 15-day moving average. This is that green line that you see here. Now, moving average is actually one of the more popular indicators that you kind of get started with, especially if you're new in trading. And the whole methodology here is that whenever the stock crosses above the moving average, then you want to buy it. And whenever the stock crosses below the moving average, you want to sell out of your long position or go short, or whatever the case is. Now, obviously, every indicator is going to work in some scenario, and other times it's not going to work. But this is, again, a very simple explanation or example of how an indicator gives clear buy and sell signals. Again, this is some of the stuff that I prefer, is to use indicators, not necessarily simple moving average, just to be clear, on that give indicators that are clear buy and sell signals. I know that the stock crosses below it, so that's my buy signal or my sell signal, whatever the case is, okay? There's also a bunch of other different types of indicators that you can add out there. So like, for example, you can add another popular one is stochastics. And so we can add, let's say, full stochastics to our chart here. And so with full stochastics, what you're looking for, in this case, you don't see any moving average up there, but what you're looking for in stochastics are these overbought and oversold zones. So basically you hear the terms, or probably will hear the terms if you trade long enough, a stock is relatively oversold or relatively overbought. But basically whenever the stock gets up into one of these zones where it's overbought here, or if it's oversold here, that those end up being the buy and sell points on the chart. And again, it just kind of correlates and gives very clear signals based on whatever you've set up as to where you should buy or sell. Now, there's a bunch of different variations in here too, and I just want to kind of go through some of these so you guys can see. We've also got things like Bollinger Bands. These are really becoming more popular. Again, very clear buy and sell signals with Bollinger Bands. you're basically looking at buying and selling the breakout of every single move. So when the stock breaks out of the lower boundary, and then if the stock ever breaks out of a higher boundary, then it didn't here, but if it did, if the stock ran up and broke out of this higher boundary, that would be your sell signal. So there's all types of different indicators out there. And again, most of this technical universe here is based on price, movement, volume, acceleration, things like that. Some other ones that are out there are MFI, which is money flow. This is another one that's very, very popular or becoming more popular. And you can see money flow has even clearer signals than some of the things like Bollinger Bands or stochastics. It's just one line, and it basically then again shows you kind of like an oversold range. So whenever the stock indicator MFI gets here, then you basically want to sell stock. So you would sell stock or go short here, or sell stock or go short here, and you might buy at these lower regions, which is buying here, etc., etc., etc. Okay, so there's a bunch of different ways that you can do it. There's literally thousands of different technical indicators out there that you can use, and I think the key is that if you are going to focus on anything, just first focus on the indicators that give clear, like mathematical reasons why there's buy and sell. So I don't prefer to use anything that's really subjective in nature, meaning that, it's a trend line that I'm drawing on the chart. How do you know that this, and this is a great example of this, but how do you know that this is supposed to be the support and resistance line versus, is this the support and resistance line? Or is this the support and resistance line? Or is this the support and resistance line? I mean, all of those things could be valid support and resistance lines, but they're all subjective to me. They don't really give us any clear indication of, why something might move higher or move lower, create a buy or a sell signal. So here's the deal. The real question becomes, which indicators really work? Which ones are actually reliable enough long-term to trade? So the question you might have is, should I be trading using the SMAs, which are simple moving averages, or stochastics, or MACD, or RSI, or all the other different indicators that are out there? Which ones actually generate a profitable trade that outperform the market? So even if you did find XYZ indicator that works, meaning that it is reliable to trade, it has good signals that work more often than it doesn't, does it actually generate profits? So when it works, do the profits overshadow the potential losses when it doesn't work? And I think that's a real key question that not enough people actually ask in this industry. So here's the deal. Back in 2014, we purchased our own in-house data and developed an in-house program to backtest technical analysis indicators. Once we had everything in place, we started backtesting hundreds of stocks and indicator variations, covering the last 20 years of market data. After 12 months of nonstop backtesting and analysis, we packaged everything up that we discovered and put it into a single comprehensive report. Now here's the deal. We are selling this report called Signals on our website. It is one of the ways that we generate money here at Option Alpha, even though we give away 99% of the things that we do, because this is something that I think is game changing. And I think it's something that everyone should have, but not everyone needs to have, or really we don't want to give it away for free because it's so freaking good. But we basically did 20 years of data, 223 different stocks, 17 different technical indicators. So we're talking about things like MACD, stochastics, Bollinger Bands, money flow indexes, volume oscillators, everything in there. 17 different indicators, 1,476 different variations. And what I mean by this is we tested the granular difference between buying at a 6-day moving average versus buying at a 7-day moving average and an 8-day moving average. Like, what's better? Do I use a 6, a 7, or an 8-day moving average? And 1,400 different variations between all of these different indicators. So the groundwork has been laid. We basically tested the living daylights out of technical analysis to see what really works. At the end of it, we ended up tracking about 17.34 million trades over the course of our year-plus study with all these different indicators and stocks. And basically, we were looking for 3 questions to be answered. Number 1, is technical analysis more reliable than randomly picking a stock's direction? Honestly, nobody has asked this question in the entire world. If all this stuff is so good, how good is it? Is it more reliable than randomly picking a stock's direction? That's number 1. Number 2, if it is, can you generate an excess return above just holding the market? Now, the question always becomes, is the market more efficient than any of these technical analysis indicators? And we wanted to figure it out. So 1, if it was more reliable than randomly picking a direction, can you generate money above the S&P 500? And if you can, what are the specific indicators and settings that worked best long term? So again, it was the difference between finding out, does the 6-day moving average as an indicator work better than the 10 or the 50 or the 100, or does the 21-day RSI work better than the 18 or the 15 or the 13-day RSI? What are the settings that worked best long term? Now, of course, I'm not going to show you all the results in this video today because you do have to purchase a copy of the report to see what works. But there are 4 things I wanted to quickly reveal to you that we learned from the report, which will help you with technical analysis regardless of if you purchase or not. And that's what I wanted to get across here in today's video, because I think just knowing these 4 key aspects will dramatically help your success rate. Again, whether you choose to buy a report or not, you do not have to. We're not forcing you to buy it. It's not required to be successful trading options. It's for the people who want to know what indicators work and what don't. But if you know these 4 things, I think it will help you get a better understanding of the relationship between profitability maybe and technical analysis. The 4 key numbers that we're going to go over here are the following. One is that exactly 39 or about 5% of the 766 different long indicator variations that we backtested beat the S&P 500 benchmark net return. This means that 95% of the technical analysis indicators that we tested underperformed the market. Now, this is incredibly important because what this really means is that 95% of the indicators that are out there are basically junk and garbage and don't really work. Okay, so your goal is obviously to backtest by yourself, buy the report from us if you want to do that, but basically find the ones that do really work. And if you can't find them, you might even be better off just not using any technical analysis at all. And that's just the reality. The average win rate of all technical indicators tested long and short was just above 45%. So what this means is that as a group, flipping a coin would have been more consistent for a strategy of buy and sell signals. Now this gets back down to what I was talking about before. You do not have to purchase this report. Just with these 2 numbers, you realize that you actually have a higher probability of success overall. We're not talking specific indicators. We're talking overall. You've got a higher probability of success if you flip a stinking coin and buy or sell the stock based on the heads or tails of that coin flip. Because as a group, everything that we tested, so many different indicators, so many different variations, as a group, they were very, very inconsistent with just being able to pick direction. Now, obviously, some indicators were definitely better. Some indicators were definitely worse. As a group, they were so-so to less than profitable with a coin flip. 208 test variations blew up the model portfolio entirely. This is about 27% of the variations that we tested. That means that they created losses of more than 100% after commissions. And notably, short-term or day trading timelines under 30 days were not profitable. I mean, this one to me is the big one because we can basically put a fork in the ability for somebody to consistently, on a long-term basis, we're talking 20-year basis here, profitably predict where the market's going to go on a day trading timeline. Now you can go, again, you don't have to buy this report now. Now you can go out, figure out if it works for you or not, try day trading, come back after a year after you've lost money, tell us that we were right, that it doesn't work. If you've already day traded, you know it doesn't work. But now we've proved with numbers and statistics that it doesn't work under a 30-day timeline. Even really, okay, just a little hint here, even 30 days plus really doesn't work. And so we'll get into that a little bit more deeper in the report. But the reality is that some of these indicators were actually so bad that almost a third of them actually blew up the portfolio. So that's cause for concern. Again, you don't have to buy the report to know this. Now you know you should probably stay away from some of the indicators that might blow up your report or blow up your account. Now, the last thing is that transaction costs as an overall percentage of gains losses accounted for approximately 7%. So generally speaking, transaction costs were not a major drag on overall profitability. And what this really means for me is that there is no link directly between people who trade more and necessarily are going to lose because they trade too much, okay? There was no direct link that we found between overtrading and profitability. So if you traded a lot, you could still make a lot of money. If you traded a little, you could still make a lot of money. So this idea that sometimes you can overtrade and trade too much, I think is not true. I think you can reduce risk by trading smaller, more frequent sizes. And again, we tested everything in our report from like a 1% allocation per trade to a 2%, a 5%, a 25% allocation per trade. We tested everything to see what really worked as far as allocation